So where are they?
So, you point to all the bad news on Wall Street.
No, not all the bad news, only some of the bad news.
For people earning money on Wall Street. Right. So, but there are pockets of opportunity. And, oil at $35 a barrel, right? That's terrible for all the companies along in the oil and gas ecosystem. However, for M&A bankers in that field, it'll be a great year because the people we talked to have indicated that this is the year that there's going to be mass consolidation. Oil companies are going to give up on trying to make it on their own, and they're going to either be sold to the stronger companies or they're going to have to raise equity. So M&A bankers in gas and oil are definitely going to be...
Or they're going to go bankrupt.
Exactly.
Right. There's huge opportunity for the distressed debt and restructuring.
So Houlihan Lokey, Lazard, these restructuring bankers too are going to have a great year, at least 1 to 2 years of excess earnings. For sure.
Or PJT, for example, the business spun out of Blackstone. They've got a big restructuring business as well.
It's been kind of interesting. Some of the stories coming out, especially this morning, are saying that even with the restructuring, with oil prices at these levels, there may not be anything left for the debt holders. So I'm not sure what a restructure looks like. They're just issuing equity now in order to pay back the bondholders, which you would have thought would have been more secure. So I think it'll be interesting to see that activity in next year.
Plenty of work for the restructuring bankers, for sure. Your CFO, Marion Lake, was just a few weeks ago talking about opportunities in Wall Street. She said rates traders are going to have a great year. One reason, obviously, for so many years that ZIRP, zero interest rate policy, now we're going to have, divergent monetary policy. So there's going to be a lot more to do for rates traders as well this year.
So, Julie, what does the Bloomberg have to tell us?
So I was looking at the MA function on the Bloomberg to look at what the deal flow has been like in energy. So this doesn't include restructuring. This is purely mergers and acquisitions. This is deals of over $1 billion in North America, either pending or completed deals over the year-to-date period. So you see here going back several years, the green line is the number of deals, and then the blue bars are the volume, the size of each deal. And so you see there has been a decline in 2015 from 2014. Another interesting theme that Alex Steele, who is sort of our resident oil maven, has talked a lot about is that there has been talk for several years now that there would be this uptick in oil and gas deals, that the bankers, analysts in the industry have been talking about it coming, and yet it hasn't quite come to fruition yet. Yes, you've had a decent number of deals over the past couple of years, but there hasn't been this explosion of huge deals that people have been waiting for. So I'm curious, Hugh, what's the sort of tipping point in 2016 that's going to make that potentially finally happen?
I think some of the language that we're hearing from analysts and from executives are just that the reticence of oil companies to sort of give up, that they thought that the prices would come back before then. And this is sort of, they've just gotten to the point where they don't have any more ability to wait and hold out.
Well, and some of them were hedged, and those hedges are rolling off. And some of them earlier this year were able to refinance for 6 to 9 months, sort of keep the drilling going, which they have to do, right? Drill or drop. And that's probably, given the volatility and instability we've seen in the high yield market, that too may make such an extension impossible.
Yes, absolutely. And that's typically, where you see a tipping point is, okay, I can't get another bridge loan and I can't access the public capital markets and the oil outlook's bad, help.
Sure, right.
So how about the electrification of finance and what kind of opportunity that creates, Hugh?
Right, electronification. We're talking about, you guys, I'm sure, talk all the time about disruption. Electronification of markets, particularly in fixed income markets. Well, it turns out that, the
Meg knows lots about this.
As a former bond trader?
Right. It turns out that
better to be former.
Yeah, better to be former these days.
In some ways, yeah. And some of the best minds at this are actually on the buy side. So you have people at high-frequency trading outfits. You have people, at hedge funds who are actually, going to the sell side. And for years the story was the opposite. And so what we're hearing from recruiters is actually some of that exodus has reversed, at least in these particular instances. Now we're talking about either assisting huge investment banks in the electronification of fixed income, or we're talking about making things like equity electronification trading markets a little more efficient.
And what about a different kind of electronification? That's quite a word, by the way. Fintech. And we hear a lot about banks, and branches don't work, and that's the future.
2015 was the year about banks being aggressively talking about fintech. 2016 is the year where you're going to see the first use cases of fintech. We're talking about robo-advisors in wealth management. We're talking about blockchain applications. And so this is going to be a huge year, and what we're hearing is that anybody who has any ability in blockchain, IT, or data management is getting hired by a big bank.
One of the findings that intrigued me in your research, Hugh, is the idea that it's not so bad to be lower down on the totem pole on Wall Street these days.
For survivability, yes. And I'm not sure about comp, but so as it's been explained to me, right now the organizations are barbelled. You have tons of people. I mean, for all they're saying about everybody wants to work at Facebook and Google, tons of new recruits. So you have lots of people who are junior. You have lots of people who are senior who never left. And in the middle, 5 to 7 years of experience apparently is the scarcity. So we're talking VPs and associates and some analysts in some cases.
Yeah,